Hi, my name is Gervais, Chief Economist at Farm Credit Canada, with a brief commentary on the decision of the Bank of Canada to cut its policy rate today by 25 basis points. Now, the Canadian economy is staring at weaker economic growth. Part of it is driven by the slowdown in productivity growth that we've recorded over the last couple of years, combined with weaker expected growth in population in Canada for 2025. And thinking about the future interest rate decisions of the Bank of Canada, obviously the threat of US tariffs applied to Canadian exports looms very large. If the US goes through and applies tariffs on Canadian exports, this will raise the cost of doing business in Canada, and businesses might have to pass on those additional costs to not only US buyers, but also Canadian buyers. So that has the potential to raise inflation. Now, if you think of the dynamics between the US dollar and the Canadian dollar, the loonie has lost quite a bit of value. And as well, this has the potential to fuel a bit of inflation. So for those reasons, the bank might have some cause to not continue with the current cycle of cutting interest rates, which really started in the summer of 2024. But thinking about as well the impact of tariffs on the Canadian economy, it is quite obvious that the impact will be significant and negative. And so that will actually give a reason to the Bank of Canada to actually loosen up monetary conditions some more and try to support Canadian businesses and Canadian households. So we do think that there are some more Bank of Canada cuts on the horizon for 2025, but I think the most important thing to note is that we don't expect long-term interest rates to fall. So even if we see the Bank of Canada cut its policy rate some more in 2025, we are not expecting long-term rates to come down even more from where they're at, and part of it is because of the dynamics between Canadian and US bond yields. But so for more information, I encourage you to go to our website at fcc.ca/economics.